You know, sometimes a market doesn't just dip, it absolutely falls off a cliff. Today, we're going to do a post-mortem on one of the most dramatic single-day crypto collapses we've seen in a long time. We're going to figure out what on earth happened. All right, let's get into it.
Just look at this number, $560 billion. That is how much value was just vaporized from the global crypto market. And get this, in a single brutal day. Okay, so first things first. To really wrap our heads around this, let's look at the sheer scale of the damage. We're talking about the numbers behind this absolute free fall.
And look, the pain was everywhere. This was not a one-coin problem, not at all. You had Bitcoin, right, the big one. It plunged by up to 11%. Ethereum, it got hit even harder, down as much as 14%. And the altcoins, oh man, we're talking BNB, Solana, XRP, they were just hammered with staggering losses, anywhere from 14 to 18% across the board. It was a total ecosystem-wide panic. But here's the thing you gotta remember. Behind all those percentages are real people, 1.6 million of them. That's the number of individual traders who got liquidated. That means their positions were just forcibly closed, their investments totally wiped out. It's just a staggering human cost.
And the sheer speed of this collapse was just breathtaking. A total of $19 billion in leveraged positions got liquidated over the course of the day. But listen to this, a stunning $7 billion of that just vanished in the space of 1 hour. Let that sink in, 1 hour.
So yeah, numbers like these, they don't just happen out of nowhere, right? They're the result of some really powerful forces colliding. Which brings us to the big question. What in the world caused this digital bloodbath?
Well, it turns out the immediate trigger wasn't buried in some complex code or a blockchain flaw. Nope, it was politics, a massive geopolitical shockwave that sent a wave of fear rippling through all the global markets. So here's how the dominoes fell. It all kicked off with this geopolitical standoff, right? Over China's control of these supercritical rare earth minerals. Then, the US drops a bombshell, 100% tariffs on Chinese tech imports. The reaction? It was instant. I mean, investors all over the world started fearing a full-blown trade war, and they just slammed the panic button.
And you know what happens when investors get scared, right? They run for the hills. They flee from what we call risk-on assets. Think about it, volatile tech stocks, and you guessed it, cryptocurrency. They're looking for safety, and that means dumping anything that even smells a little bit speculative.
And I really want to stress this. This was not just a crypto story. The S&P 500, the NASDAQ, the Dow Jones, even the FTSE 100 over in London, all of them took a nosedive. The fear was absolutely global, and crypto just got caught right in the crossfire.
But, and this is where the story gets really interesting, the tariffs, that was the spark. Okay? But something else had to be the fuel. Because many analysts are arguing that there was this hidden internal weakness, something lurking in the market's plumbing that turned what should have been a bad day into an absolutely catastrophic one.
Yeah, this quote right here, it gets right to the heart of it. The theory goes that it wasn't just the external shock of the trade war. The real problem was a hugely popular and supposedly safe hedge fund strategy that just suddenly and violently imploded. It was like pouring gasoline on an already raging fire.
Okay, so what was this strategy? It's called the cash and carry trade. Now, it sounds super complicated, but the basic idea is actually pretty simple. It's an arbitrage play. Hedge funds were trying to make a tiny, supposedly risk-free profit by exploiting the little price difference between buying Bitcoin right now, say through an ETF, and at the same time agreeing to sell it later using a futures contract.
All right, let's just walk through it. Step 1. A hedge fund goes and buys the actual asset, like a spot Bitcoin ETF. Step 2. Literally at the exact same moment, they short it. They sell a Bitcoin futures contract. Step 3. They pocket the difference between those two prices. Boom, profit. It's supposed to be market neutral, totally safe, or so they thought.
So here's the catch. When that tariff news hit and panic spread, this whole carefully balanced trade, it just fell apart. The price differences went completely haywire, and that risk-free profit engine, it suddenly turned into a massive ticking liability. The hedge funds had no choice. They had to get out fast. They had to unwind, basically just dump their enormous positions all at once. So think about it. What happens when billions and billions of dollars of something are dumped onto the market all at the same time? You get what's called a liquidity vacuum. It's like all the buyers just vanish into thin air. And the sellers? They're desperate. They're forced to just keep dropping their prices, lower and lower and lower, just to find anyone willing to buy. That is what put this crash into hyperdrive.
Okay, so now we have our two culprits, right? On one hand, you've got this external political shock, and on the other, this internal financial time bomb. Let's see exactly how these two things collided to create the perfect storm. So it really was these two things smashing into each other. You had the external shock, that's the trade war fears, the tariffs, all the global panic that created that first big wave of selling. But then you had the internal fragility, the massive unwinding of all those hedge fund trades, which just sucked all the liquidity, all the buyers right out of the market. And that's what really accelerated the price drop, sending it into a total nosedive.
So if you want to think about it this way, the tariff announcement, that was the match. But the billions and billions of dollars tied up in these super over-leveraged hedge fund trades, that was the gasoline, just waiting for a spark. So what are the big takeaways from all this? What do we learn? Well, first, geopolitics and crypto are way more connected than you might think. A single policy announcement can and did crash prices worldwide. Second, all these super complex financial strategies, they can create these huge, hidden risks just bubbling under the surface of the market. And finally, this whole thing is just a massive reminder that high volatility isn't a bug, it's a feature of the crypto ecosystem, at least for now.
And that leaves us with one last, big, lingering question, doesn't it? If a single political announcement can set off a chain reaction like this, one that wipes out over $500 billion, well, it makes you wonder, if the foundations are that fragile, how stable is this whole market, really?